Can you hear me? Can you hear me?
Yeah.
Okay, sorry. So the personal exemption is worth $4,000, and that goes according to each person that is on the tax return. So if you have husband, wife, children, each person on that return is worth $4,000. That's off of your income before it's considered for tax. And then there are different criteria in which dependents can be considered for the tax return, and we'll kind of talk about that here in a little bit. There's the dependent taxpayer test, the joint return test, and then the citizen of residency test. The dependent taxpayer test means that they have to actually qualify as the taxpayer's dependent. And we'll talk about that here in just a little bit. The joint return test means that the taxpayer's dependent may be married. However, they're going to file a joint return with their spouse only to get their withholding back, or that's pretty much just that they're going to get their withholding back. Other than that, they wouldn't be required to file a joint tax return with the dependent wouldn't be required to file a joint tax return with their spouse. And then the citizen of residency test just means that they are a resident of the United States, Canada, Mexico. And qualifying child. So the child must be the taxpayer's son, daughter, stepchild, foster child, brother, sister, half-brother, half-sister, stepbrother, stepsister, or a descendant of any of them. So if you have children and maybe their children live with you, you take care of the children, you might be able to take that child, the grandchild, as a dependent on your tax return. The other criteria is that the child must be under the age of 19 at the end of the year and younger than your spouse if filing joint. If the child is at the age of 24 at the end of the tax year, a student, and younger than you or your spouse, then if the child is permanently and totally disabled. So basically what it means is if you have a child between the ages of 19 and 24, they'd have to be like a full-time student. They couldn't provide all of their support. So that's where that is. And again, it's whatever their age is as of the last day of the year. The last day of the year, if they are born on December 31st, then you get the tax benefit for that year, even if they were just alive for a couple minutes. Same thing as if somebody were to got married. The child must have lived with you for more than half the year. The child must not have provided more than half of his or her own support during the year. The child must not file a joint return for the year unless the return is being filed only to get a refund of income tax withheld or estimated tax paid. So if you have a child that's married and they want to file a joint return with their spouse, but you actually, can claim the child as a dependent, the only reason why the child is filing a joint return with their spouse is to get their withholding back, then you can still claim the child as a dependent. And then there's what's called a qualifying relative. So there's qualifying child, and there's also a qualifying relative. The qualifying relative, it cannot be your qualifying child or qualifying relative of another taxpayer. So sometimes we run into situations where you have maybe a parent that somebody's trying to take care of, and you have multiple siblings that actually take care of the parent. As long as one of the siblings isn't taking all the tax benefits for that parent, somebody else can take that. So that's where I've seen that come into play. The person must be related to you in one way listed under the relatives who do not have to live with you rule, or must live with you all of the year as a member of your household, and the relationship must not violate local law. The person's gross income for the year must be less than $4,000. That's that personal exemption that we kind of talked about here. You must provide more than half of the person's total support for the year. Now to kind of talk about the relatives that don't have to live with you, it's going to be your child. Like if you have a child that's in college, they go away to college, they don't technically live with you. They might have their city of residence or their address of residence might be with you, but they're away at school. Stepchild, foster child, or descendant of any of those. And also anyone who's legally adopted is going to be considered your child for tax purposes. It's your brother, your sister, your half-brother, half-sister, stepbrother, or stepsister, your mother, father, grandparent, or other direct ancestor, but not a foster parent. So if you have elderly parents and they happen to live in maybe a nursing home, but you're paying most of the cost of, being able to keep them in the nursing home, things of that, because their legal residence is in the nursing home, but you provide the support for them, you can still claim them as a dependent on your tax return. And stepfather and stepmother, the son or daughter of your brother or sister, the son or daughter of your half-brother or half-sister, your brother or sister of a brother or sister of your mother or your father, and your son-in-law, daughter-in-law, father-in-law, mother-in-law, brother-in-law, and sister-in-law. So those are all relatives who you may be able to claim as a dependent if you provide more than half their support, but they don't necessarily have to live with you in your home. When it comes down to taxes, record keeping is probably very vital. I mean, it's one of the most important things, especially if you have to get audited. There's basic records that you keep, and that would be like your income records, your income sources. If you have W-2s from employers, wages, if you receive any type of retirement benefit, Social Security, you'll receive all these tax documents. They probably should have fluttered in about maybe, a week or so ago. Those are items that you definitely want to keep. Anything that has to do with your home, like when you originally purchased your home, or property taxes, maintenance and repairs to your home, those types of things are important to keep. And then if you have any investments, like if you have any Merrill Lynch or Edward Jones accounts or any type of investments that you have, you'll get a broker statement with that information on there. That's something you're going to want to keep as well. As far as the time frame to keep your records, anytime you have a return, you want to make sure that if it's a return that you actually filed, that you want to keep it for about 3 years. The way that works is that right now the IRS has a year that's considered an open years, and then they have the current year. So the current year that we're filing right now is for 2015, and then the open years would be 12, 13, and 14. So any of those 3 returns can be amended for any reason if there's something that was not originally correct about it. So those are considered the open years. Now on April 18th of this year, 2012 will become a closed year. So that return can no longer be amended for any reason. If you have income that's not reported and it's more than 25% of the original gross income on the return, the limitation on that is 6 years. If you file a fraudulent return, there's absolutely no limit. And if you don't file a return, there's no limit as to how far it can go back. When you file your tax return, you're going to compile all your income, all your adjustments, and then you're going to come with what's called an adjusted gross income. And then you have an option to go with a standard deduction or an itemized deduction. And this dollar amount actually comes off of your income before your taxable income is calculated. So the standard deduction is based on whatever the government sits for that particular year. There's different dollar amounts based on the filing status, and they usually inflate that, every year a little bit. So for this year, if you're going to do a married filing married filing separate or single, the standard deduction is $6,300. Married filing joint or qualifying widow or widower is $12,600. Head of household is $9,250, and then there are special additional standard deductions if a person is age 65 and or blind. That can be added to that. And then itemized deductions are, you kind of go either one. Itemized deductions are where you try to compile some deductions to come off of your income to try to exceed your standard deductions, because you can take one or the other. So since it's going to impact your taxable income, you want your taxable income to be as low as possible. So you want to go with whatever the higher of the two is. I just listed some common itemized deductions. There are quite a few of them, but I just listed some common ones that I see on a regular basis. Medical expenses that were paid that exceed 10% of adjusted gross income. However, if you were born before January 1st, 1951, the amount for the medical expenses paid only has to be at 7.5% of your adjusted gross income. And that's for anybody that's on the return, the taxpayer, the spouse, dependents on the return. Mortgage interest paid for first and second home, and that would be points as well. So if somebody has their primary home, and maybe they have a recreational home up north. Those two, you can write the interest off on that. If somebody has a travel trailer, there's certain criteria. Like if it has a travel trailer, I think it has to have sleeping quarters and bathroom quarters in order to be able to write the interest off for that as well. And then that information is also reported to you from your mortgage company on a 1099 for how much was paid throughout the year. And it goes the typical January 1 to December 31. Personal property taxes on personal residents, property taxes on personal residents that were paid for the second homes that were paid in the year. You cannot deduct taxes if they were just incurred. You have to have also paid them in the year. License tabs for vehicle are known as personal property taxes. So if you have license tabs for your vehicles, you can compile that onto your itemized deductions, add that in there. And then if you have any job-related expenses that are not reimbursed by an employer that exceed 2% of the adjusted gross income, then you can write those off as well. Investment income expenses paid. And then I did have it on there too. I don't know where it went, but it's safe deposit box rental. You can do that as well. I see some people writing, so I just want to give people a chance to catch up to. I don't want to go too fast. Okay, and then there's after your income is calculated, you have your adjusted gross income. You minus off your itemized, your standard deductions. Then you come up with a total income, and then you minus off your personal exemptions. Then you come down to what's called a taxable income, and that's what your income is. That's how much tax or how much income you have that it's going to be taxed by, and this is pertaining for the federal. Then you have some different things called credits. There are what's called refundable credits and non-refundable credits. Non-refundable credits only reduce your tax liability. So whatever the dollar amount is that you've had calculated for taxes, this will help reduce that. There's child and dependent care expenses that you have, if you have, education credits, retirement savers credit, child tax credit, and residential energy credit. I didn't put this on here, but there are certain limitations once an adjusted gross income gets to a certain dollar amount. Some of these credits have fluctuating Agi limitations is what they call it. So if somebody has a larger amount of income, the credits might actually be reduced or phased out completely depending on where their income is. But this will help reduce your tax liability. And then we're going to get into what's called refundable credits. And refundable credits are after your tax has been calculated, then you add in your withholding, and then you add in any refundable credits. And then that actually helps with your bottom line, either reduces your balance due or increases your refund. The common ones that we see are the earned income credit, additional child tax credit, and an American Opportunity Credit, which is it's a college education credit for taking higher level college education courses. I kind of wanted to break down the federal tax brackets so that you can see what the income limitations are and what the actual tax brackets are. Because for federal, this is how the taxing system operates. Well, there's actually two ways of this, but this is probably the most common one that we see. There's a 10% bracket, and it tells you if you're single, married filing joint, or married filing, head of household, what the income limitations are at the 10%. And then 15%, 25, 28, 33, 35, and then 39.6. And so these are pretty much how the taxes are calculated for the standard tax federal tax brackets based on the income for filing statuses. Our favorite topic, Affordable Care Act. This is something that we've been learning a lot here in the last couple of years because of the fact that it has impacted our tax world the last couple of years. The law requires that the taxpayer, spouse, dependents have health care coverage, an exemption, or to make a payment with a return. If you can purchase coverage through what's called a health insurance marketplace, and then based on what some people's income is, they may qualify or may be eligible for what's called a premium tax credit, which will help pay the premiums for this particular coverage. And then for 2015, I just kind of put in there what the penalty is, and for 2015, the penalty for it is 2% of your annual household taxable income, or $325 per adult and $162.50 per child, with a maximum of $975. And then in tax year, it's going to go up to 2.5% for tax year 2016. You had some kind of insight about how it would impact for tribal members. Do you want to just talk about that?
Tribal members, if they do not have health insurance, a lot of them will be exempted if they are descendant of a tribal member. I know all the ones that receive per capita out here do have access to Blue Cross Blue Shield, but if you're actually a descendant of them, or if your parent was and you're a descendant of that parent, you will also be exempted from having having health insurance.
And don't you also have to be signed into a tribal clinic?
You should be able to have access to the clinic.
Yeah. So as long as you have access.
You would do the marketplace, so you have to show proof of being in a federally recognized tribe too.
To get the premium tax credit?
That must be one of the questions that they ask when they go through the questionnaire for.
Yeah, when you go into the marketplace, they will
Marketplace,
ask you.
As a non-tribal member working here, we have Blue Cross.
Correct.
But we also pay part of it. Is any of that we pay in attributable
To the credit, no, it is not. No. But you are covered, you don't have to worry about getting other insurance because you do have it through your work.
You don't pay
You
tax.
can't take you don't get any benefit, because the amount that you pay, you don't actually pay tax on that money,
Okay.
okay?
Of course, now we're talking about penalties. Penalties there's different financial penalties for income taxes. If there's what's called a failure to file penalty, and if you don't file a tax return in a particular year, there's what's called a failure to file penalty, and it's usually 5% for each month or part of the month that the return is late, but not more than 25%. The penalty is based on the tax paid by the due date without regards to extension. So that October 15th date is considered the extension. You'd have to actually go by the April 15th date, not the October 15th. And then if you pay the tax late, it's a half of 1% of unpaid taxes for each month, part of a month, after the due date that the tax isn't paid. The penalty does not apply during the automatic 6-month extension if at least 90% of the tax is paid on or before the due date of the return. So basically what that means is if you have a balance due on your tax return, and if you file an extension and if you paid at least 90% of the expected tax due, because you won't know what your tax return or what your tax due is going to be, you can just kind of estimate it. If you pay at least 90% of that, then you'd be exempt from that paying tax late penalty.
I mean, I haven't filed my taxes on here, because I delivered to paper. But the IRS, Katie Mathis, she took 2 of my paychecks, and a part of another. You know, and that's when I got with gas for Charlene's help, get them straightened up, because, you know.
Did they do a garnishment? Is that what they did?
Oh, they took the whole check, huh?
They took a
Memorial weekend.
So they probably filed I'm sorry, not a garnishment, but a tax levy.
Oh, yeah, shit, that would hurt, you know.
No doubt.
So they take up to 80%, don't they?
Yeah, I think it's.
They took it all.
Yeah, I'm saying at some point I think they can take 100%, because I know the federal can too.
Gotta open your mail, just saying.
Yeah,
I'll give
absolutely.
it to you.
I mean, you might want to just kind of pull one of us aside here in a little bit. We can kind of talk to you about it. Maybe about filing return, just to
Yeah.
make sure that's in there. 'Cause
Now I got
basically, what they're going to do is when they send you something like that, they're going to send to you only what they have.
Well, I've been
required.
ignoring it for a minute, you know, and now you got my attention by just
That'll get your attention. won't it? Yeah, that definitely gets it.
I had all the food on this, takeout. Couldn't buy it. I was gonna cook out. Cause those steaks.
I put a little damper on that, didn't it?
Oh, yeah.
Yeah, if you definitely want to talk to one of us, we can, kind of give you a little
Yeah,
bit more
well,
insight
I
on
think
that.
it's going smooth now, they're getting some money, and they take most of my check.
Yeah, basically what they want you to do is they want you to file a tax return to show what you've got.
Right.
There's some things that you may have that they don't know about, because they're only gonna get what
Oh,
the
yeah.
employers are reporting, what the, any type of income that you have. They're only gonna know that part of it. They're not gonna know if there's expenses, if there's self-employment income, if there's,
Dependents.
yeah, they're not gonna know any of that, so
They
that's
do
kind of
So-
the reason that you file the
Yeah.
return.
At all. So what they say that you owe might not be the right amount that you
Exactly.
owe them.
Right.
Until you file that return and show them what you have, then they're gonna keep, they're gonna just come up with their own computation and take it from you, so.
Do keeping receipts help? How many do you buy, stuff like that?
Only if you itemize your deductions, and one of the things I didn't put in the itemized deductions was state and local income tax that are withheld, or then there's also, whichever the grade of the two is, state and local taxes withheld, or sales tax paid. Sales tax paid could be, there's a table that the government has that says, okay, based on the amount of people in your household, your tax household, and, the amount of income that you have, there's a table that says how much sales tax that you should pay. But if you purchase a large item, like you purchase a vehicle, or you purchase, a travel trailer or something like that, you pay a large amount of sales tax, that can be added in addition to, but the sales tax amount that the government sets aside for you. And then to try to exceed, because you wanna go with the higher of the two, either state and local income tax that is withheld, or sales tax, one of the two.
What do you mean, make it look like you don't make that much money?
Well, that's where you would take your income and then you have, if you
Yeah,
have expenses,
yeah.
but your itemized deductions helps to reduce your
I
taxable
mean,
income.
what about work gear, it's like,
I'm sorry, what was that?
what about work gear, that stuff there's not.
That would be, if you can go back to the itemized deduction slide, Susan, we can kinda talk about.
I mean, sometimes you gotta have my desk
Okay.
here ahead of
Yeah.
time.
So there's what's called job-related expenses. Those have to exceed 2% of your income, your adjusted gross income, and then anything over and above that can go on the itemized deductions. But keep in mind that you have to compile all of this together in your itemized deductions to exceed your standard deduction. Can you go back to that slide too, Susan? The standard deduction slide with the amounts? There we go. So based on your filing status, if you're single, you have to exceed $6,300. If you're married filing separate. If you're married filing joint, you'd have to exceed $12,600 of all of those. And again, there's more itemized deductions than what I put on there. That I just kind of put on there the general ones that we see. And then you've got your head of household. So does that?
Can I give you a couple hypotheticals?
Sure.
Okay, take for example, we got this satellite reservation over in Saginaw, in Standish, around there. A lot of times we have challenges on working here at this part of the tribe and then having to go over there, and sometimes we don't get reimbursed for mileage to go ahead and make our trips over there.
Oh, yeah.
Could
there's
we
no-
consider that a job-related
Job-related
expense?
expense, yes.
Okay.
What's the
Yeah.
mileage?
The mileage to and
Here's
from.
the trick with mileage. To your home and from your home is not deductible. So if you work, just for example, let's say I live in Saginaw. So if I'm going to commute every day to Mount Pleasant to come to work, and then I'm going to go home, those mileages are not deductible. But if I, like his example, if I come to work here at this location and then I have to go to another location, that mileage from here to there is deductible. But going from my house and to my house is not deductible.
Okay, and the other part of that would be, a lot of times, we have to go ahead and to go to a lot of these functions where normally we'd be dressed casually, but a lot of us, we have to get that business attire to go ahead and
Oh,
go
yeah.
to these functions. Can we?
Dry cleaning.
Yeah, dry cleaning and, wardrobe stuff, related to the job. If it wasn't for our jobs, we wouldn't be buying that stuff.
Yeah.
Here's the rule of thumb with that. If it's something that you have to purchase for work and it has like the logo and things like that on it, then it's typically deductible. But I'm in the same situation you are. I have to have business clothes for work. That's a requirement. But I can also wear that to the mall. I can also wear that to a funeral. I can also wear that to church. So typically, no, those aren't deductible. But if they have, like if I were to purchase, like her sweater has H&R Block, that is something, because she purchased that, she could write that off.
So, take for example, if we were to get a tribal logo jacket
And it's required, and if it's required.
There you go, that would be, then you could write it off.
Yeah. Plus the laundering of it. You can do that. So yeah, if you have certain items like if somebody works outside doing construction, we'll say, they're gonna have to have like heavier jackets on because of the fact that it's, cold out. You have to, in gloves and boots. Yes, those would be considered because typically you're not gonna wear those at a normal circumstance. But like something like what I have on, yeah, I can wear my suit to a church. I can wear my suit to a funeral. I can wear my suit to the mall if I wanted to. I have other options that I could wear it to. I just, but yes, it is required for my job.
Well, see, I was asking about work here, because some of these boots are not cheap.
Yeah.
Red Wing starts at $100 right there, so.
Yeah, and if it's something that's required, obviously for safety reasons, by all means, then that is a deductible expense. So yeah, and you might want to keep that up, but keep in mind you have to exceed your your standard deduction.
What about motel? Sometimes they call me to drive down to Romulus, and I have to go, someplace to crash,
Yeah, if it's not reimbursed by your employer and it's required that you stay overnight, yes.
But it has to be required that you stay overnight.
Right.
Oh, yeah. After a long day of work, I'm ready for a shower.
Yeah, so let's say for example you're going down there on a Monday and you have to work there Tuesday, Wednesday, then yes,
Oh, yeah.
because you're gonna have to stay overnight because it's
Yeah.
required for you to be there the next day. Then yeah.
Well, they've done this to us, we were planning to work down there a couple days, next thing you know, we gotta go all the way to Benton Harbor.
Yeah.
And then find another hotel, and now I lose my deposit on that one. It just piles up. Cool, answer my question.
In the itemized deduction listing, when you have, would your Blue Cross premiums that you pay, plus, like we had like 3,400 we paid in expenses for doctor, hospital, does Blue Cross premium also, the ones that we pay?
It depends on whether or not it's pre-taxed or after tax. So if it's going to come out of your check pre-tax, you're already not paying taxes on those funds, so you can't deduct it. But if it's something that you pay out of pocket after tax, then yes, you can deduct those on your medical expenses for premiums.
Pills.
Prescriptions are covered too.
Yes, prescriptions. Medical expenses would be like doctor visits, health insurance premiums, prescriptions, mileage,
Do those include office visits too?
office visits.
Yes, any copay,
Okay.
X-rays, lab work,
Because ours is $20.
dentist, eyeglasses,
Yeah.
orthodontics.
even plastic surgery.
Yeah, depending on whether or not it's for cosmetic purposes or if it's for, required purposes. Cosmetic purposes, no. Required purposes, yes.
But shampoo?
No, shampoo doesn't cut it.
Nothing over the
Except
counter.
if it was something that you had a prescription for.
No, they work in it.
Ready to move on?
Yeah, let's go. Oh, we were at the questions part anyways. Yeah, we were there. Yes.
I have a question. How far back do you have to keep your taxes?
Let's go back to that screen.
7 years or something like that?
It's
3?
typically 3.
3 years, yeah.
3 years?
Oh, I missed that one somewhere.
Oh, you passed it.
It's almost in the.
It's
Oh,
like
it's in
probably in the first few slides.
Oh, okay.
So
There we go.
There it is.
Here's the record keeping. So if it's an open year tax return, which would be like using for example as of today. 12, 13, and 14 are open years, and then 15 is the current year. So you want to keep everything 3 years. So on April 18th of 2016, 2012 is going to become a closed year. So you could actually, dispose of 2012 if you wanted to. If you have income that's not reported, that exceeds 25% of the adjusted gross income of your return, then it's 6 years for that. And if there was a fraudulent return filed, no limit, and if no return was filed, there's no limit on it. So how far back they can go. So typically about 3 years. Yeah.
I have a question, and hopefully I can leave after this is answered. I received a mortgage debt forgiveness.
Okay.
What I would like to know, my husband and I filed joint, there's a percentage, right? Isn't it like 25%? Is that like a cutoff on your income?
Or
Is it 25% of your income?
for the cancellation of debt.
No, if it's included as, because it says here that I have to include it as part of my income. Wrapped into the, is it a total 25% over, oh, I don't know, I guess that's why I'm asking.
I don't believe so. I think it's gonna add it to your income and then it's gonna go based on whatever your income, whatever the tax bracket is that would put it into your income.
Uh-huh. Oh, I see, I have to have a certain amount. I'm thinking I fall under the 125.
Okay,
Yeah,
so if you
that's
were.
what I was looking for,
I'm
or
gonna
the
call it that, yeah.
150.
So it probably is gonna put you in the 25 or 28%
Yeah.
tax bracket if it puts you up there. With
Okay,
it. So it just depends on where your income is gonna be with
Uh-huh.
all the income combined.
okay, so what, have you dealt with these before, as far as, can they be stretched out over a period of time?
I don't believe so.
Or does it have to be filed right away?
It would have to be filed in the year that it was received.
Yeah, 2015.
Like,
Yeah. It would have to be filed in the year that it was received.
Now, how does the interest on that work?
That would be an itemized deduction.
Okay. Good to know. All right, I can leave now. Thank you.
You're welcome.
Getting back to the exemptions for dependents, I had been thinking this over. I think my daughter answered it last night, but I'm gonna run it by you.
Okay.
She is 22, so she's between 19 and 24. She's a part-time student,
Okay.
and she's living with us, you know, so we provide that. But she works full-time, so she files a tax return. And if she says she can't be claimed on another, then she can't be claimed on mine, even though she's living with us and not paying rent and.
Yes.
It depends on what her income is, because if she's between the 19 and 24, and she's a full-time student at least 5 months of the year. So if she's a part-time student,
Part-time, she's going accelerated, so every.
so it depends on how many credit hours she has, but it also depends on how much income she has. As to whether or not she would have to, whether or not you would be able to claim her as a dependent, or she would claim herself.
Okay. Well, how do I know what the income level is on that end?
Anything over 4,000.
Yeah.
It's what?
Anything over
The personal
4,000.
exemption.
Oh, over 4, yeah.
Mhm.
She's making-
Yeah, I'm thinking if she works full-time, she probably
She
does.
probably makes more than
So
that.
she probably wouldn't be.
So, but she'll wanna make sure she's claiming her education credits.
Okay.
Yeah, which is really gonna help her.
The education credits you can file, you can claim, but it wouldn't cover like if you receive scholarships and grants, tuition assistance from an employer. Those would have to be deducted from the actual tuition cost.
But she's claiming those.
Yeah, even if she's taking student loans out, because at some point in her life, she'll probably be paying that back, so it's really out of pocket. Even though she's not paying it out of pocket at that particular moment, if she's taking student loans out for it,
Right,
yeah, then that's a credit she'd be entitled to.
yeah, okay.
Let me know if I'm correct on this one. When I look at that tax bracket, I'm thinking, well, my daughter, who is a tribal member who is over 18, even though she's going to school out of state, and she receives per capita payments, and she uses our address, and we still help her with her education and a lot of that other stuff, she still has to file because she's in that 25% tax bracket, and we cannot claim her as a dependent. Is that correct?
Correct.
She's between 19 and 24. She's a
Yep.
full-time student out of state.
Yep.
Do you provide more than half of her support?
Not with
Not
her
since-
receiving per capita,
So,
but
then you
we
cannot.
still help her out with her education
Yeah.
and
Right, it would
expenses.
just have to be
You're
more
such a
than
nice
that
dad.
50%.
Do you want another daughter?
good job.
Well, the whole idea here is, as tribal members are ready to file their taxes, if their tribal member son, daughter is over 18, they're automatically gonna have to file anyway.
Yes, they
And the
will,
tribal
yeah.
member wouldn't be able to claim them as a dependent.
That's correct,
Right, right.
because they make too
And
much
really
money.
at that point, you would want them to claim themselves because it's gonna help them lower their taxable income.
And as you mentioned, to go ahead and make sure that they're claiming those education credit exceptions too.
If they're eligible for them, if they're paying out-of-pocket
Okay.
tuition and books for their first 4 years.
I mean, just to kind of give you an example of a single filer, if you have somebody who's single and they go standard deduction as opposed to, the itemized deductions, between their personal exemption and their standard deduction, the standard deduction is $6,300, your personal exemption is $4,000, so there's $10,300 of income that's not taxable on federal. So that's kind of how that part would work, and then it would determine whatever income bracket they're in, but you can automatically take out in this case $10,300 of income from taxes. Yeah, if they're still at let's say $37,650, then they'd be in the 25% tax bracket.
So I have a few questions, just to clarify some things. On your qualifying child, if the child turned 18, they're still in high school, we had a question come back from a member that their tax preparer didn't allow them to claim that. What would be some of the stipulations why they wouldn't qualify? If they're still in high school, they just turned 18, they have no income.
I can't see of any reason why
I
they
can't
wouldn't.
see any reason why they
Yeah,
wouldn't
that
claim them,
doesn't
yeah.
seem right.
Okay.
Because the stipulation is that they don't provide more than half of their support. They were a full-time student at least 5 months of the year. So that
And if
right
they
there,
didn't have any income, then
Yeah.
there would be no.
somebody has to support them.
Okay. The next thing is assisted living facility. If you are living in an assisted living facility, whether it's medically necessary or you're just living there, is the rent that you pay there tax deductible?
If it's medically necessary, then it would be under the medical expenses, am I correct? It would be under the medical expenses for the standard or the itemized deductions.
So then they would have to meet that 7.5% or 10% requirement.
Right.
Correct, depending on what their age is. But if they're just living there for other reasons other than it's required medically, then no, it would not.
Okay. The next thing is we had a question about gambling wins and losses. Can you explain a little bit more about those?
Sure can. Good question.
Do we have to
Okay,
claim it?
so
Yeah,
gambling
you have to
wins,
claim it.
yeah, gambling wins you do have to
What
claim.
dollar amount though?
We can go back to the itemized deduction screen. I was going to put that on there, but I didn't. Gambling losses can be deducted on the itemized deductions as what's called not subject to the 2%. And it has to, but it cannot exceed the gambling winnings. So if somebody wins $10,000 in gambling winnings, the most that they'd be able to write off is $10,000 in losses. You can't write off $20,000 in losses and $10,000 in winnings. The most you can do is write off up to the limit of how much you've won. But it has to go on the itemized deductions. If it's $500 and you can't itemize, then that's just a $500 loss.
Is there a percentage based on that this year? Or if they won $10,000 and say they gambled $30,000, is the whole $10,000 claim written off, or is it?
Well, you have to show that you still have to show the gambling winnings on the return, and then you would show the gambling losses on the actual the itemized deductions. It balances it out, but it does still have to be reported on there. You can't just say, okay, well, I had $10,000 in winnings and I have $10,000 expenses. They wash out, so I'm not going to put it on there. Because, as you know, whatever facility you win the money at, they're going to send that information into the government.
And the government doesn't know that you're gonna write that off,
Right.
so
They
they
don't
just
know that
see
you
that
have
as
those losses.
income.
So like,
How do you prove the losses?
There should be some kind of a documentation that you can get from the actual facility.
You can, we've
Yeah.
seen them come through, you can actually go right into the institution there and, they'll print you out on if you have a Players Club card or something with that, then you can, get your statement of winnings and losses, and it shows it right there for you, so.
Okay, so let's talk about that win-loss record from casinos. You're gambling, you say you spend $1,000 gambling, it shows your winnings as $200,000 and your losses at $40,000. Is that gonna be questionable if the IRS comes back and says you need to prove your gambling losses? Because the win-loss record from the casino looks at every time you win 50 cents, every time you win $1.
Exactly.
So is that a true and accurate record to show your wins and losses?
It is, 'cause, I mean, technically, it's saying that you won that much money. So that's where the statement is gonna help you out. But now there's some new rules that are coming through, and you might be able to help me out with this a little bit more, where it doesn't talk about, it compiles everything as far as per visit, as opposed to like every time, per visit meaning like within a certain time frame, like within a 24-hour period. But if you go from one casino to the next casino to the next casino, those aren't considered the same visit. They're only and then it would compile your net for that particular time frame. That make sense?
What other forms are proof of gambling losses?
I'm sorry, what's that?
What are some other forms of proof of gambling losses?
ATM receipts. You know, if somebody can say, okay, well, I took $500 out at the casino. Here's my ATM receipt. Manual receipts would work. You know, if you can write down dates and things like that. I mean, the IRS can pretty much say yay or nay to any documentation that they want. These are just some of the things that we can say recommend. We can't guarantee you that they're going to accept that as their method of proof. But if you have something directly from, you know, a casino that says this is how much you won, this is how much you lost, that's going to hold more weight than anything.
What amount do we have to claim?
51 cents.
Really?
Rounds it up to $1. 49 cents or under, you're good. Yeah, technically, anytime you win, even like I said, 50
I thought it
cents.
was like $1,100 or $1,300.
Well, that's when they're required to, give you a,
Yeah.
record it,
That's what
to
I'm
give you a
saying,
slip, that's it.
Yeah, they're required to report it when it reaches a certain dollar amount. That's why they ask for your social security and whatnot. But technically, if you won $10 on a scratch-off lottery ticket, you're supposed to claim that as income. If you're due jury duty, you're supposed to claim that as income if you're not reimbursed by your employer.
And
I have another one. Say for instance, I'm 67 years old.
You look good for your
My
age.
wife is 50. I collect Social Security. I'm a tribal member. I live within District 1. And I go to file joint taxes. My wife is non-native. She pays state, federal, city tax, whatever it is. Because I am collecting Social Security, a tribal member in District 1, I am tax exempt. And I file my tax return. Does she qualify of reimbursement for her whole state tax?
if she is not a member, she's not eligible to subtract off her, state income tax.
Right, and at that point, they would prorate you as the member of the tribe inside that agreement and would take, I mean, if you just have social security, I guess it doesn't matter, does it?
You have to be a member of the tribe to be able to take off your state.
And in addition.
Is there any credit at a point where you are 67 years old and your wife is working where you're retired and would get that credit? We've had it happen. Where she would get, you would get a credit because, not just because he's the tribal member, just because he's retired. Is there any credit where his wife would,
I've not
Receive.
seen any.
that's
no,
under the age of retirement?
Nope,
I don't think so.
I have not seen any credits.
Why is it that this isn't my tribe here, but I still pay in the state?
Because according to the PAC agreements that this tribe has reached with the state, you have to receive your income from this tribe, and you have to live within the boundaries of this tribe, and have income from that tribe to be able to take it
Basically, you
back
have
up.
to be living here,
Right.
working here to receive your state.
Right.
You pay in the state, but you can receive it back if you're living here and working here.
But
for
if
this
you
tribe.
went back and lived where your tribe was, you would be able to not pay tax on the income that you earned from that tribe.
Right. But I lived here and worked here and still had to pay in the state.
We have to. I still do too. I pay in my state tax, but at the
Mhm.
end of the year, because I live here on the boundaries and I work for the tribe, I can get that back at the end of the year. You have to pay, and you
But are you
receive
a
it
member
back.
of this
I'm a
tribe?
member of a different tribe.
Oh, okay.
I'm a member of a different tribe too, but I've always paid it, I never got it back.
Am I correct by saying that there's something when you file your Michigan return that would prompt that to come back as part of the refund?
RTM,
Okay.
4013 is the form that it's called.
So what she's saying is there's a form that you file with the state of Michigan when you file your state of Michigan return to show that you are a tribal member and
Working for a
that,
tribal entity.
Yeah, and
you
then-
live
within its
within
boundaries.
the agreement ultimately.
so then whatever was withheld from Michigan would be as not, would be considered a credit back and then it would be refunded back when you file the return.
And that's usually, we ask for what's called the blue card, you know, to show what they got, the red card and the blue card, right? If you have that blue card and you show that to us when we're doing your taxes, then we fill out that RTM 4013 and you get that tax back. So that's almost a surefire way to know.
Any other questions? Okay. Thank you. I appreciate your time.
Thank you very much.
You can come up and just kind of ask us individual questions too if you have, something that you just don't want to talk about in the group. We'll be here.
We appreciate your time very much.
Thank you.
Nobody has any questions?
Yeah, because.
I do. He said, give me a ride back down.
Okay, well, thank you very much.
Oh, you're welcome, thank you for having us.
And thank you, everybody. Enjoy your day.
I warm it
Thanks
up.
for coming up. Joyce, I hope I see you Thursday. This Thursday is the regular housing workshop, and it will be on Social Security. We're doing one at noon and one at 5:30.
I don't think I qualify
So, Thursday. So, if you're able, we will have lunch.
You got a flyer or something?
No, I don't. It's just Thursday.
We
Thursday.
do have our business cards up here if anybody wants to grab one of those.
But you guys had said.
If you want to put your email address on where you signed in, and if you didn't sign in, please do so for both us and the presenters.
Down here because of the trees.
Stay warm.
Hey, I'm running him down.
He works over at.
He's not listening to me. I'm running him back.